Benson. Sorry to cut you off there, Alina. My email is thhicks@nexamortgage.com. So Alina was asking my email address, but I imagine every person watching this right now at the very beginning of the show, thhicks@nexamortgage.com. Hit me up for loan scenarios, questions, comments on the show, hair tips from Scott. Anything you want to know, hit us up. So Alina, how are you?
I'm good. Type your email and speak at the same time. And you know what? I'm not very good with the multitasking.
You know what? Scott and I will talk for a second here. We're in the all black shirt. What is it today? Wednesdays, all black shirt Wednesdays. We got the memo. We're matching. This is the uniform now for the Real Estate Mortgage Insiders. We're wearing black shirts. We're going to look uniform. We'll look like industry style, right?
Well, this is the Manhattan look. You're only supposed to wear black in Manhattan. So,
is that what it is?
So we got it. We can all strut through the city and we will fit right in. So
now next Wednesday, when I go to my laundry pile and I find the only clean shirt and it's blue, it'll be blue shirts for your uniform. So just so you guys know, I'll try to sync up with you guys with my limited laundry.
Great. So Ted, today sounds like, and then let's let everybody else know this too. It sounds like today, what's going to make the most sense for us is to go through an investment property scenario, because Alina has a client that is looking for a couple of investment properties. And what we're going to be talking about today are the different options that we can look at. And it's really interesting because, Alina, and we hadn't talked about this beforehand, but we get a lot of leads that come through for us. And I have to say right now, Ted, correct me if I'm wrong, but I would say 90% of the leads that are coming into us from our prospective clients are all revolving around DSCR loans, which is
wrong.
Wrong.
Probably 99% of them.
Oh, all right. Well,
tell me more about this type of the loan, please. I know that a lot of people will be interested in it.
Well, a lot of people love DSCR just because you don't have to prove out any income, right? So W-2s, paycheck stubs, none of that makes a hill of beans worth of difference to this deal. The only thing that matters is your credit score, your down payment on the property, your experience doing flips, and the experience regarding flips really plays into what down payment percentage you can get approved through the lender. So
correction on that, Scott.
Yeah.
DSCR is not a fix and flip loan. So,
I'm sorry.
Your experience as a landlord with investment properties matters.
Yes.
So he's making sure I'm awake. I know you.
The experience. They're looking at the experience.
Yeah. So for example, somebody like you's got a real estate portfolio. You're going to be easier to approve because you already have real estate in your portfolio, so they see less risk with that. You're an experienced investor. So someone like you, we can usually get a lower down payment all the way down to 15%. Typically, we start at 20, 25%, depending on the borrower. And then we're looking at your FICO score. And so to Scott's point, it's a huge advantage for people that, a lot of self-employed people make a lot of money. Don't show they make a lot of money, for one. I don't care what you make. It doesn't matter. I care what the property makes. So as long as the property pencils, when we run the math between the income it generates versus the principal, interest, tax, insurance, HOA, okay? Ideally speaking, it's at least breaking even or cash flowing. We can go cash flow negative if we need to. Of course, you're going to have a less advantaged rate on that. Perfect scenario, it's cash flow positive, and you have a great FICO, and you have experience, and you can get the best rate.
Well, the best scenario is a 1.25 ratio. So if you
1.25.
Yeah. So ideally, right, the most ideal scenario would be that you cover your everything associated with the maintenance cost of the property, your P&I payment, insurance, everything else, plus an extra 25% with the rental income. If you hit that number, you'll get the lowest rate DSCR that is available. So
what is the lowest and the most exciting rate as of now?
Let's see. Ted, is it now 1.5%?
On DSCRs? Yeah, of course. Alina, 1.2. No. I've seen low sevens approaching sixes, but those are with higher down payments.
Yeah.
Most people don't want to put the 35, 40% down to get that incredible rate.
Yeah.
So typically they're about 1% higher than what a conforming rate is going to be.
So close to 8%?
Closer to 8%. Just depends on the scenario. I mean, and they change daily, sometimes hourly. Now, one of the advantages, and again, we've talked about this in the past, because not all brokers are created equal. Why do I say that? One of the advantages of doing this is you can put in an LLC and not affect your personal income debt to income ratio. So when that client of yours wants to go buy another mansion and they have this rental property on their credit file, it could affect their DTI. Now, if it's cash flowing, it'll offset, but if it's not, it could affect their debt to income ratio. We put in the LLC and we make sure the lenders that we work with do not report it to your credit report, so it doesn't show up in your personal credit.
And we've been doing a lot with forming LLCs out of Wyoming. It's a great place to work. It's inexpensive. We've got a group that we work with there that for a couple $100, give them 24 hours, they'll have your LLC set up. They can get you set up with a bank account, the whole ball of wax. So you're ready to move quickly. And
why Wyoming? Why not Delaware?
That's a good question. And it's expense. And it's the service associated with it. So you can do it in Delaware, but to get a service bureau to do it, it's about double the expense. And it really, it's from our perspective, we're not lawyers. We should caveat that. But from our perspective, it doesn't really make much of a difference. And Alina, the other thing you can do if you set up the LLC is if you bring investors into your deal. And we were talking about this with a guy out of Northern California. So he was talking about bringing people in to help him with the down payment on an investment property. And he was saying, well, I could get it set up as a loan to me. And I'm like, well, maybe better yet would be set them up as a capital provider to your LLC, give them membership units in the LLC equivalent to what they would have gotten. And now they're owners, right, in the property, in the LLC. And you then don't have to report that as debt, and because it's not debt, it's equity in the LLC, which is then put into the property. So it's a way for you to bring in third-party money into a deal without it being debt. They still get their payoff because you write it into the terms and conditions of the LLC, what the payment terms are for them. You accomplish all of the same things, but you do it in a way that won't negatively affect your opportunity to get the loan.
Yeah, and the other side to going to Wyoming, and I'm sure Delaware is the same, is just the privacy. So, you have this in your LLC, it doesn't come back to you. There's no record of the owner of the LLC. So if somebody is going after when you're hiring clients and they want to sue them, and they start searching for what assets they have, it's not going to show up as an asset they own because there's no connection in the records of who owns that LLC. So it's an asset protection strategy that we'd like to implement with our clients. So that's the other side of it.
Yeah. So strong privacy, and they've got a good base of law. I mean, that's, you're always looking for somebody that's got good case law in the state when you're establishing an entity. And Wyoming, believe it or not, has some really good case law. So it's a good place to look at. But Delaware works. That's not an issue. We just have some connections there that we help clients with.
Speaking about state of Florida, we don't have a private. It's very easy to set up the LLC as long as you have a physical address that you can register the LLC on. You don't have to have a registered agent. The beauty about state of Florida, there's no state tax, as we all know. So that's helps a lot when you create and manage your LLC. But again, there's no privacy. So anyone can go on sunbees.org and see they can see who is the registered agent of this LLC and who is the manager. You can play with it, and I saw many people play with it. What they do is they create a Wyoming or Delaware LLC that is the manager of this LLC, and those LLCs that are local own real estate here. And Delaware company owns a lot of LLCs. This company owns like 5 or 6 LLCs, state of Florida. So that's one of the way how to slice it. Another interesting way that my clients were using, they were using Cayman Island. Is it Cayman Island? I think it's a Cayman Island company that will own Florida LLC, and the Florida LLC will own the property. Why Cayman Island? I hope it's a Cayman Island. I don't want to make it's a British. It's
a British territory. Yeah.
So what it means when you are international client, and maybe it doesn't make a lot of sense when the purchase is little, but when you are international buyer and you buy real estate in the United States, doesn't matter if it's state of Florida or any other state. If first of all, when you need to sell this property, it might be complicated because you will they will withdraw the percentage. What is percentage they withdrawing to 15 or 20% up to I don't have the numbers in front of me, but that's not the main reason, because you can avoid this problem by creating LLC with multiple members. The problem is if something happens to you and you die. If something happens to you and you die and you're not a resident, then whoever is going to inherit this money, they will have to pay significant taxes. And if it's a large amount of money and expensive property, that's going to be a huge problem if you are not resident and people that inheriting this property are not residents. So you avoid this problem by creating the structure that I just mentioned. That's for mostly for high-end clients, because to maintain the structure, it's not cheap. So you have to spend a couple $1,000s a year just to maintain the structure.
Right. Well, in all of them, there's going to be a little bit of a fee, and people could also look at establishing their LLC in California, and it has the advantage of not being private, always being taxed. So clearly the place that everybody wants to look at right away. So yeah, but there's some great places. But Alina, that's a great strategy that you pointed out. And, for international clients, it can really work well, but you're right in that you got to look at the maintenance expense for the entities versus the protection and savings that it's going to give you. And there's this trade-off. You have to get at a high enough value in the property for it to really start to make sense. But yeah, it's there are several reasons to do it, and that's all of us here collectively work with our clients then to define, help them define what the best entity is. They can talk with their attorney about getting it done, but at least we can help them give them a big picture of what to look for. So Alina, what would you like to, Ted? Did you take a look at the email with the subject properties or?
Oh, I did not. Let me do that. Let me go back to that in a second here.
I was working and multitasking by sending the email and talking at the same time. That was tough.
Yes.
I sent you 2 emails, and both of them are income generating property, multifamily. The interesting part and why this is something that will be exciting for investors in state of Florida is we all hear about how many people come to state of Florida and how many wealth is coming from California, from New York, and from other states, but we don't hear about how many people live in state of Florida because they cannot afford living here anymore. This is not necessarily my clientele, because this is people that used to rent properties for $1,000, $1,200, $1,500 a month, and they cannot afford it anymore because those rental doubled. So if you could rent 1-bedroom apartment for $1,200, now it's $2,200. And people have to move. Actually, they're moving not necessarily from outside state of Florida, but they're moving from Miami-Dade County. Miami-Dade County becoming to be less and less affordable. So what is the strategy and idea for investors? Start buying properties that can be rented for just here. Oh, okay. I'm gonna type the address right here, so that people can afford and people can rent. Be in this sweet spot under $2,000. How you can do it? It's multi-families that I spoke about. You can find it on AGK Realty. I'm gonna send you the address right now. Just 1 second.
Cool.
I'm gonna give the addresses. That's gonna be very centered.
There it is.
Oh,
got it.
19 Front Street, Salamanca Avenue.
7 Salamanca. 7 Salamanca.
Okay.
Yeah. 7 Salamanca.
All right, let me look that up.
So that's going to be very interesting because the location is great. It's right on Coral Gables, and Coral Gables, we have a lot of wealth coming into Coral Gables, but then we have people that have to maintain and work in restaurant industry, in hotel industry, and schools. So unfortunately, we don't think about that part, and it's going to be a big problem very soon for the whole Miami-Dade County. So if this void,
Can you run us through what the while Ted's looking that up, what's the just as an example, what's the purchase price on this property and what's the rental?
7 Salamanca Avenue will be a $2.2 million asking price. Not necessarily, we probably can negotiate. It has 6 units. Every unit is rented for $2,500 a month.
Wow.
Right.
So you can do the math. Yeah, and it's really well located.
Yeah.
This is one of the examples of the multifamily that will definitely be generating a stable gross income. The question is it qualified for the type of the loan?
It does.
Base purchase price. It does.
well, let me back up. I shouldn't say it does based on the math. What I was going to tell you is that we can do a multi-unit with the DSCR up to 10 units without exception. We can go above with exception. So just looking at it face value, we can definitely present this. Scott, what's the math on this? And I'm going to do quick math on
so let's do this. Let's figure out some basic stuff on it. Let's just say hypothetically right now it was a 20% down. So there's some opportunity to go with a lower down payment potentially, but let's just say a client came in with 20% down. That means the loan value is $1.76 million. So let's take $1.76 million, and then let's put
a 9% interest rate on it.
How much you gonna put?
I'm gonna put 9% interest rate just for our math, and I'm putting 20% down. I have a mortgage calculator here.
All right.
So your payment is going to be $14,380, and that's with a projected tax and insurance. Now, obviously, in Florida, that's going to be a lot higher. So call it 15 grand. Call it 15 grand. And how many units is it, Alina?
It's 6 units, $2,500. It's going to be less than expenses, unfortunately. So it's going to be negative income.
No, 6 units, you said?
No, it's 15 grand. But the monthly rental is 15 grand, Ted. So you're sitting.
Oh, that's right.
Yeah. You're sitting at about 100.
You're breaking even. People breaking even.
It's a 1. It's a 1. And every year it's going to get better because you're going to increase rents, right? 6-7% probably annualized. So it won't be long till your cash. So that's an example, Alina. If we were looking at this on the ratios, this would be a 1.0 ratio. So approximately. And if you're looking at 1.0, there we have DSCR providers that will go to 1.0 on the property. So, the goal would be between down payment and discount to get it down to that 1.75 million approximately, right?
Mm-hmm.
And then you'd have something that's right at the edge of 1.0, right? And I think
it's right there.
You really want to get to 1.0 because your rates are better at 1.0 and above than something below that, right?
Mm-hmm.
And
we do have no ratio options, or they'll go down to 0.75.
Yeah,
it's upside down by 25%. But again, like Scott said, that's not the best solution, but you still qualify.
Yeah.
Oh, I'm sending you the second interesting option. I just love how it looks. It was built in 1926. It's a very traditional, like old Spanish style in Coral Gables. The price is $1.625 million, but it has only 4 units. It's 4 1-bedrooms. The numbers are next. 3 of the units are rented for $1,700 and 1 unit is $2,100. But the interesting part about this particular property that it's in the area where vacation rental is allowed. So basically you can double on it. You can easily rent this unit for $3,000 a month each if it's short-term rent. Easily.
Well, so you're looking at $7,200 a month if you do long-term rentals, right? And
yes.
If you're looking
at, I'll do the mortgage on it.
I will definitely increase the rate because it's definitely below the market value. Right now in Coral Gables, you can find a property, 1-bedroom, less than $2,000 a month. So they definitely rented it probably long term and never increased the rental rate.
Well, so what's the rental rate right now? The total that you
I would say
$7,200, Ted. $7,200.
Okay, so this one, the payment, and this again, low insurance is $10,678 with 20% down. So this one does not pencil as good as the other one does.
But if the short-term rental, so one thing we do have some DSCR providers that will go off of short-term rental income if that's the way it's going to be used, and so we could go to the rentalizer and we could take a look at that property address, and then we could get estimates on the rental income based upon that. The only thing is you really want to have a projected occupancy rate greater than 65%.
Well, the challenge with that.
Yep.
Yeah. The challenge with that is as we get to multi-units, there's going to be less and less because the RDNA are limited in the numbers, and DSCR that are multi-unit are limited in numbers. So I'd have to find the perfect mix between the two, and I don't know that exists. I'd have to do my research.
Yeah.
But either way, that other one pencils. I mean, that other one's a great opportunity.
Good.
Now let's say
if we're going to be able to negotiate the price, that's going to be even more exciting. Well, the second one, I absolutely love how it looks, and the only problem about this particular property can be, since it was built in 1926, it can be historically designated. Once it's historically designated, it's might be complicated when you want to change something, or down the road if you want to demolish it, then they're going to allow you to do this. Let's say, because people, when they look into like this, they say, okay, maybe down the road I'm gonna demo and build something else because it's multi-panel, maybe I can go bigger. So in this particular case, when it's old Spanish house located in Coral Gables, one of the most strict city with building codes and with the regulations in historical department, so that you might hit the wall with this property.
Well, the other nice thing is if you have 6 units, you're not hit as hard if something goes vacant, right? It's just when you have more property, it removes the risk profile associated with property as an owner. Forget about the lender side, right? Just as the owner, you've got a little bit more flexibility in terms of how you can cover the mortgage payment. What were you getting ready to say, Ted? I'm sorry.
I was going to ask Alina, what do you happen? I know that your boyfriend does pools, so he's in construction. Do we happen to know what the build cost is in Florida for per square foot?
Well, we have a very interesting numbers before pandemic and after pandemic. After pandemic, the numbers on the build cost almost doubled. And now it's very hard for me to see. You used to, before pandemic, be able to be within, depending if it's not a luxury real estate, to be within $150 per square foot to build. And now I don't think you can do anything less than $200 for not for luxury, because once you go luxury, the limit is the sky.
Yeah.
So it's it all depends on the finishes and everything, but not luxury, regular, building cost will be around 200 per square foot.
So nothing that we would find you in. Nothing that we would find you in. That would be a home like for Ted and I. Would be the $200 a square foot.
A room for you and I in the backyard.
Right. Yeah. All right.
What does land go for over there, Alina? If you wanted to find a decent lot that had entitlements with the water and sewer and electric already there, what could you find land for?
Oh, that's extremely difficult question, because our land value vary. It's so many factors that depend. You can buy a land for $400,000 for 10,000 square foot, and then you can buy a land for $10 million for 10 feet. Why? Yeah. Because this is a waterfront, and it's just extreme. Yeah. We have a huge split between the numbers. Well, it all depends.
Let me add more color to why I asked these two questions. So we have an FHA program that allows buyers and borrowers to buy land, build a house as long as you're within that FHA limit, still put 3.5% down, and close one time on a loan. It's called a one-time close with an FHA. So in theory, if you add
financing the construction.
FHA loan, the loan covers it all. So we can literally finance.
And the limit is 535?
Correct. In your county, yes.
Sorry for interruption. 537.
So can we find a lot that somebody could build a new home that they would live in that 535 range? Because it's pretty interesting. Think about it. 3.5% down, you get to build a home. And what's interesting for you and I is that they closed the deal. The loan closes and the land transaction happens before they start building. So what they do is they have
one more time for people like me that need to process.
Yes. But this again, it's called a one-time close.
FHA loan, are they going to finance your purchase of the land as well?
Correct.
So 537 includes the land cost and the construction cost.
Correct.
You have to find. I mean, slavery doesn't exist.
Okay, what if it's a 1,500?
Because let's say, for instance,
1,800 square foot home.
Let's do the math. You're buying $1,000, and then you are at 200 per square foot. You have to build at least 2,000 square feet. Otherwise, why to build less than 2,000, right? So 2,000 square feet.
Homes that are 1,800 square feet. Yeah, you're not going to pencil.
Yeah, you're like at $800,000.
It's $400,000 for the property. It won't work.
Yeah. So in your area, that won't work. But what about if you go more inland, in the swamp?
You cannot build in the swamp, and it's going to be the construction cost will be more expensive. So it's tough, because then in order for it to make sense, you have to find a land for $200,000. You still can do it. It's just not the neighborhoods that I'm particularly excited about.
Yeah.
Hypothetically, yes.
Maybe it's a Wynwood scenario where the neighborhood's up and coming, and somebody can get in.
Wynwood is already up. It's not coming.
No, I said a Wynwood-like scenario.
Yeah, you can go to. I always have a problem with stating this in the neighborhood Alapatha. People probably from my area say like, "Hey, that's not how it sounds." This is very close to Wynwood. I mentioned this area many times, but again, it's becoming to be expensive as well. Alapatha. Probably I'm right this time. So it's super close to, it's north of Little Havana, and it's west from Wynwood. So centrally located, amazing area. If you are a long-term investor and you have enough money to buy secure properties and you're not afraid on a mixed, weird, strange neighborhoods, I guarantee you that in a couple years from now, this area will be doing very, very well. It's just it can be other way around because it's very centrally located, and everything will start moving this way because there's no affordable prices in one district. Even Little Havana becoming to be very, very expensive.
Yeah.
I also believe in Little Havana. I also believe in Little Havana, but it just takes so long. I thought it's gonna pop much faster. It's located between Brickell and the Coral Gables, so the location is really by taking a long time for it to really get the full potential.
All right, I took a little side journey and a tangent. I want to bring it back to the DACR and let Scott make one point, because this is going to be very relevant to your clientele base. Scott, there's a specific loan that we're looking for Alina's clientele that are non-resident. These are international investors. Does DACR work for this?
It absolutely does. As a matter of fact, not only does it work, but we've got, I think we did the count on this. And Ted, if I remember correctly, I think we have 38 lenders that will do foreign nationals with a DSCR loan. So we've got a tremendous variety of loans that we can look at and a tremendous number of lenders because, as you can tell, when you take a look at these, the ratios are important. The credit scores are important. A lot of things play into which lender we would go with. And if we really want to shop it for the best rate, we have to have a lot of options. So we didn't even realize how many we had that could service that market. So, Alina, when you've got somebody and that's what they want to do, I know you have so many cash buyers, but if somebody wants to make that cash go further and get into multiple investment properties, that can be a great way to do it.
Scott and Ted, before we wrap it up today, I know that you give the picture for this particular loan that doesn't require the tax returns.
Right.
What if a person comes to you with a perfect tax returns and says, look, I'd rather to get the better interest rate and I want to buy this multifamily property. So what picture are we looking at with the, let's say the same first example with the 20% down, $2.2 million property, and person has great tax return, great credit score, can provide you with everything needed.
You're going to save a point. You're going to save 1 point on the interest rate for sure.
So he's going to be in the seven numbers, like 7-ish.
And probably mid sevens, I would say right now, based on where we are right now, you're probably looking at mid sevens. Ideally, you put 20% down. So, kind of if you're looking at an ideal scenario, 20% down, you can document the income, you can document, everything across the board. Then you're looking at saving a point on the interest rate expense. So, it can be, it's really worthwhile if you've got the documentation, right? You want to do it because 1 point adds up over the long haul for your overall expenses, but not everybody can do it. So, but this particular client that you have sounds like they can probably pull together the tax returns, and then we can save them a point on the rate, which means it cash flows a hell of a lot faster, right? Because you got less expense associated with a loan.
Yeah, and we can definitely look at the tax returns and their business returns and work back in stuff that they've written off to help increase their qualification. So, yeah.
2 years tax returns, right?
Yeah.
2 years tax returns, business returns, but then we can look at the business side of things and what they wrote off and help rework that stuff back in. So stuff you depreciated and taken off that lowered your tax basis, we can work that back in to increase your income if needed. You might not need it.
Yeah. Okay, sounds interesting. Yeah. Thank you so much, Scott and Ted. It was extremely interesting. At least for me, one of the most interesting.
Beautiful.
Well, we love doing this. We love talking about options, and this is what we do every day. So, Alina, thanks for the questions, and as always, it's great to see you. Ted, you got to do our sign off.
I'm telling you, for the Real Estate Mortgage Insiders, Ted Hicks, Alina Meledina, Scott Benson with the Black Shirt Crew. We'll see you next week.
Bye all.